And like I said, we'll just wait a few more seconds, get people logged in. Got a couple of people joining in, and then we'll go ahead and get started. All right, I'm going to say, well, first and foremost, I'd like to thank all of you all for taking time, like I said, out of your busy Saturday to join us for the Home Ownership and Taxes, What You Need to Know webinar. My name is Jared Rogers. I'm the president and CEO of Wilson Rogers & Company, and we are located here in balmy Chicago, Illinois, even though today is a little bit better, but earlier during the week it was quite cold, so, you know. With that being said, let's go ahead and proceed. As I did mention, at the top of your screen you do have some icons, so if you do want to ask a message, I just simply say, you know, you can type it in, but we will have a Q&A session. So if you delay your question and just hold on to it until we get to the end, that'll help me be a little bit less distracted. But needless to say, what are we going to go over? We're going to talk for approximately about an hour. The presentation itself will probably only be about 45 minutes, and then we'll leave about 15 minutes for Q&A. And with that being said, we're going to go over deductions, what are available to homeowners, what you can and can't deduct, and things that you want to consider. Owning a home does come with a lot of expenses, but unfortunately Uncle Sam does not let you take all of those expenses off on your tax return. So we're going to show you what you can and can't deduct. We'll also go through the mechanics, how to take the deductions, whether or not you would use a paid professional such as ourselves, or whether you decided to go it alone and do your own tax return. We'll show you how and where you can claim your deductions and those credits. And then we're going to talk about some considerations, things that you want to keep in mind. A lot of things that Uncle Sam lets us take off are subject to amounts, limits, thresholds, and then, of course, since, you know, we've been doing this for quite some time, there's some insider tips that you want to keep in mind, and this will kind of just help you plan better. And then as a gift for everyone who has attended this session, we are going to have a special offer for you. So stick around. Hope you stay to the end. And then once again, any questions that you have on your mind, we're going to give you time to ask about anything that is unclear or that we may have missed. All right. So without further ado, who are we? Well, like I said, we are Wilson Rogers & Company. We were founded in September 2005 here in Chicago, Illinois. And yes, as you can gather, that means we've been in business for 10 years now. We service both businesses and individuals in the areas of tax, accounting, ancillary services such as bookkeeping, payroll, you know, you name it. And we also do IRS debt resolution. So if you find yourself in the unfortunate situation of owing Uncle Sam and can't pay it all at once, we are there to help and assist with that matter. In December 2011, our company expanded our presence and we opened our first retail location in the Beverly Hills neighborhood. So if you aren't familiar, we're located at 2055 West 95th Street. In 2016 will be our 5th tax season with this office. So, you know, and things are already starting off pretty eventful. People are already calling and sending in information. The thing to know is that we are real people. Like I said, my name is Jared Rogers. I serve as the Chief Executive Officer. I spent approximately 13 years in corporate America prior to switching and heading up our office here. But I've got over 16 years worth of real-world experience. I am a certified public accountant, and I'm actually licensed in the state of Illinois, so I actually can practice in Illinois. And then I hold a BS in accounting and an MBA in managerial finance. Bunch of letters behind my name really doesn't make a difference, but anyway. And then the company was founded with my wife, Aranita Rogers. She serves as Chief Operating Officer. She's an experienced human resource professional. She handles most of consulting type matters. And she's also holds the SPHR credential, Senior Professional in Human Resources, and a BA in Business and Finance. So that's a little bit about who we are. Now let's go ahead and get into the mechanics of why you're here. So the deductions that are available to homeowners kind of fall into two camps, things that you can deduct and things that are not deductible. So on those things that are deductible, the biggest game changer when you own a home is, of course, mortgage interest, okay? And mortgage interest is defined as any interest that's secured by the taxpayer's home. So what this includes is it can include your first mortgage, it can include your second mortgage, it can include a line of credit. You can get a line of credit that is secured by your home, and that counts as, mortgage interest. You could also have an equity line. So if you have equity in your home and you apply and get this HELOC, home equity line of credit, that also counts. Mortgage interest is deductible on your first and second home. And we'll get into the mechanics about first and second home and what constitutes a second home. But just know that if you have a first home or a second home, say maybe you had a home prior to marrying your spouse, or you just simply have more than one home, you can deduct it on the first and second. However, you can't deduct it on the third or fourth or fifth. All right? And then mortgage interest is reported to you on Form 1098. So when you file that first tax return as a new homeowner, you're going to get that nice Form 1098 in the mail. 1098s and all the other forms were supposed to be mailed out by this year. It was the 2nd of February, the 1st of February. They're usually due out on the 31st of January. But all of you should be receiving them. And if you haven't gotten them, your particular lender may not mail them. They may just put it on your online portal under tax documents. So if you haven't gotten it, you can make sure that you can retrieve it from there as well, okay? But that's going to tell you how much mortgage interest you paid. And the one thing to note is if you got the form, Uncle Sam got the form. So if you are entering in the information, you want to make sure that you're entering in the amounts that are listed on the form, not more, because then Uncle Sam will question that. One little key thing to remember is that if you bought a home, and let's say, I know this happened with myself, we bought a home, the lender was, call it ABC Bank, then a month later we got a letter saying that our mortgage had been sold to XYZ Bank. Well, you should get two 1098s, okay? So you should get one from the first lender for however long they serviced the mortgage, and then another from the other lender, indicating that they have they've picked up your mortgage and, are reporting what they've got. The next big game changer is, of course, taxes. So, and this is the second biggest item. The thing to note with this is that your taxes are going to be paid one of two ways. They're either going to be paid via escrow, which means it's part of your monthly mortgage payment, or they're going to be self-paid. So, some people and some lenders do not do escrow. So they'll simply say, hey, guess what? You pay your taxes on your own. So if you pay your property taxes via your escrow, the lender is usually going to report them on Form 1098. However, if you self-pay, you're going to want to make sure that you keep track of that, either have your tax bills, or you can go to the county assessor's website and enter in your PIN or the property address, and they'll tell you how much property taxes you've paid. But once again, those are deductible, and that's usually the second biggest game changer. Another thing which comes into play with some people is points. Now, you may be saying, well, hey, Jared, never heard of points. What's a point? All right. A point is a form of prepaid interest. So think of it this way. If the lender says, hey, based off of your, earnings and your credit worthiness, we're going to give you an interest of 6.5%. You say, I don't really want to pay 6.5%. And they'll say, okay, well, you can pay a point, and we will make that interest rate, 5.5% or whatever it may be. So like I said, it's a form of prepaid interest. You pay it to the lender, and therefore it reduces your interest rate. This sometimes is referred to as loan origination fees, loan discount, or loan buy down. Once again, all of these things are paid to the lender for a lower interest rate. With regards to deductibility, they pretty much follow the same general rules as mortgage interest, meaning that, you can itemize and you can deduct them. However, they are generally deducted over the life of your loan, but there are some exceptions, which we'll talk about a little bit later, that if they apply, you can deduct them in the year paid. And sometimes points, you may not find them on the 1098. They are generally found on the closing statement. You may have heard this referred to as a HUD-1 or a RUSPA, but basically the documentation that you signed your life away and spent, hours signing with the attorneys and all those good people. Those documents that you have will usually indicate if there were any points that were paid. So make sure that you give that HUD or that RUSPA or those closing statement to your tax professional, or if you're doing it yourself, look on that. It will tell you if any points were paid. Last major thing is closing costs, okay? So with regards to closing costs, the same items above, meaning interest, taxes, points, if they're listed, as part of closing, then you're able to deduct those. So if you have a loan in which, you're supposed to prepay the interest for a month before it gets set up with the bank, or, if there are property taxes that are paid between you and the seller, those will be listed there. So those closing costs, sometimes they're deductible. So once again, that'll be something else that you'd want to provide to your professional. And then the last little item, may also take PMI. PMI is private mortgage insurance. It's basically insurance that the banks charge you in order to guarantee that they get paid. So it's kind of weird, but anyway. Private mortgage insurance premiums are another thing that is deductible. And we'll kind of discuss that, on the subsequent slides. Now, what is not deductible? It's not uncommon for individuals to come into the office and say, hey, I paid this, and I paid this, and I did this. Can I deduct it? And we unfortunately tell them, no, you can't take that because it's not one of the items that Uncle Sam, allows. So what are the things that are not deductible? All right, under closing costs, things such as title fees, real estate commissions, appraisal costs, your home inspections, your doc stamps, your credit reports, there's a host of different things. There's lots of things that, aren't deductible on the tax return. However, you should note that most do add to the value, or what we call in the tax parlance, basis, of your home. And they can come into play at the time of sale. So let's just say that, all of those different things, you paid an extra $5,000 at the closing table, and, the actual cost of the home was, $155,000. That would make the value of the home worth approximately $160 from a tax standpoint when it comes to calculate a gain or a loss. I won't really belabor the point here, but I will go into it a little bit later on so that you can kind of understand it. Certain improvements. It's not uncommon for people to say, hey, I put in a patio and built out a second home office and I got a pool and all those things, and I can deduct that, right? Well, not so fast. Uncle Sam says no. Basically, anything that is non-medical or health-related is not going to be able to be deducted. But once again, it does add to the basis. So, if you put on a new roof, it makes your home more valuable. And once again, related to gains or losses, that would come into play. The other thing is that, the medical and health-related improvements may be deductible. We will discuss that a little bit later because there are some rules that pertain to that. Your insurance, meaning, your homeowners or AKA hazard insurance, that is not deductible. And this insurance is not the same as the mortgage insurance premiums or, the private mortgage insurance, that we will discuss. Other items, association dues. Unfortunately, if you purchased a condo, your mortgage interest is deductible, your property taxes are deductible, but those dues that you pay to the association, those are not deductible. You kind of have to think of it this way. Those are things that if you weren't in the association would usually constitute maintenance, repair, upkeep. So, hey, with me, I pay, for the lawn to be done, the furnace breaks, I pay for that guy to come out and fix it. Those things aren't things that we can deduct on the tax return. So once again, since our association dues are usually covering maintenance, those aren't things that can be deducted. Depreciation under most conditions is kind of beyond the scope of this presentation, but if you owned rental property, then you would be able to take depreciation. There's a section that we will talk about a little bit later as it relates to business use of home. That comes into play. But for most people, depreciation isn't something that they're going to be able to write off. And for those who don't know, depreciation is nothing more than a tax allocation of the value of the home taken over some years. So if I buy a home for $100,000, the IRS may say, hey, guess what? You can deduct that home's cost over the course of 30 years, which means that I would get to write off $3,033 over the course of that time. But that doesn't apply to homeowners. And then there's certain local assessments which are not allowed. So meaning like, I have a client lives downtown. They built a brand new $60 million park, and they charged all the property tax, owners a piece of that park, and they have to pay that assessment. Well, that assessment, is not deductible on the taxes. Assessments will include things like, sewer, sidewalk, new parks, things like that. The construction of new items, that's not deductible. However, the things that maintain, the integrity of something, those are deductible. So once again, you would just have to look at what assessments you could take. All right. Moving on to how you take the deductions. All right. The first thing is that you must itemize using Form 1040 and Schedule A. So, yes, this does mean that you will have a more expensive tax prep experience than what you've had before, because when you don't have a home, you typically take the standard deduction. And the thing for you as a taxpayer to know is that the IRS gives you whichever is greater, okay? So in 2015, if you are single or married filing separate, the standard deduction is $6,300. If you're married filing joint, it's $12,600. Or if you are head of household, meaning you are a single parent individual who has a child, you can deduct $9,250. But let's say that the cost of your mortgage interest, your property taxes, and a couple of other things that we'll discuss a little later exceed the standard deduction. Well, Uncle Sam is going to give you whichever is greater, okay? So if I have $9,000 worth of items and I'm single, I'm going to take the $9,000 itemized deduction versus the $6,300 standard. Now, if I only had $4,000 worth of itemized deductions, I'm automatically going to get the $6,300 standard. Most tax professionals as well as software are going to default, so it's not something that you have to worry about. But as I indicated, as a homeowner, you're going to itemize, you're going to use Schedule A, and what you're seeing in front of you is a copy of the 2015 Schedule A. This is going to require you to keep some records. So, I tell people, hey, if you've got a folder, a box, spreadsheet, however you want to do it, you want to keep track of, your property taxes, invoices, things that you kind of paid for, etc. And like I said, yes, it does take a little bit more effort than simply, taking the standard deduction, but it usually pays off for itself, when done. And then the key to note is that, certain limits may apply. So as we look here on the screen, you'll see at the top, under itemized deductions, you've got medical and dental expenses. You'll see taxes you paid, and you'll see letter A, 5A is income taxes. Number 6 is real estate taxes, so this is where the real estate taxes get reported. You will see that 7 is personal property taxes, so if you pay taxes, certain states will allow these deductions, but if you paid taxes on, let's say, like a vehicle or an RV, a boat, something like that, that has a tax that is calculated based off of the assessed value of the item. So meaning like, the assessor says, hey, your boat is worth $30,000, so you have to pay, a vehicle use tax or a boat maintenance tax. Those things are deductible under personal property taxes. And then as we look down, you will see interest you paid. Number 10, that's the big one for homeowners. Home mortgage interest and points reported to you on Form 1098. And if the points aren't reported to you on 1098, you would see that in number 12. And then, like I said, if you paid mortgage insurance premiums, you'll see that in line number 13. The key to note about mortgage insurance premiums is that your income has to be within a certain up to a certain threshold. Otherwise, it gets phased out, meaning it will be disallowed. But we'll talk about those items a little later. Moving right along, we have how to take deductions continued. And I wanted to highlight here that certain credits are taken actually on the face of the Form 1040 itself. They are not taken on Schedule A. And what I mean is, if you look down and you see 53, that is residential energy credits. That's usually the biggest thing that homeowners can take with regards to a credit for owning a home specifically. You can see it says attached schedule, attached form 5695. And if you make certain improvements to your home, say envelope items such as doors, windows, insulation, heat-resistant roof, heating, air conditioning, stoves, water heaters. A lot of us are familiar with those Energy Star-related items. those are the items that, energy efficient that we can then claim a credit for. And we'll talk about the mechanics of the credit as we proceed. However, you can also receive credits for energy efficient property such as solar water heating, solar electric power, solar wind systems. And I know you may be on the phone saying, yeah, well, in gloomy Chicago, we don't have a need to get solar because we don't have sun here until pretty much May throughout the winter. But we have a client that was out in Connecticut, purchased a solar roofing system. So he basically has, panels on his roof, and he takes the solar, feeds and powers his whole house, and then he actually backfeeds the excess energy back into the grid. So actually, the power company pays him for generating power, which is actually a pretty cool thing. But we'll talk about the mechanics of how that credit works. But you can receive up to 30% of the cost of installing those items. So, you can see it can add up. If you've got like a $30,000, roofing system, you're able to deduct those. So just know that that the credits, like I said, specifically to owning a home, can be taken on the face of the Form 1040 itself. All right. Now, this is probably the best piece of the presentation, or at least in my opinion it is. The things to keep in mind, because this is where we kind of earn our money. There's a lot of things, like I said, people know to take. However, this is where the devil is in the details, so to speak. So the things that we want to keep in mind is, like I said, Uncle Sam places things within certain limits, so there's only so much that can or they will allow to be deducted. So let's look at the left-hand side, and we'll look at what is homeowner-specific, okay? Mortgage interest. So the first thing to realize is that there's a $1 million limit for the interest deduction, and that $1 million isn't $1 million in interest paid. It's $1 million in debt. So if you have a high-value home, this happens very frequently to our taxpayers in the state of California, because the property values escalated so much during the late 90s, 2000s that a home that was $200,000, could easily be $1.1 million. But with that being said, if you're buying a house now in California, you could easily have a $1 million mortgage. All right. However, the interest deduction gets adjusted, so to speak, when that debt exceeds the $1 million. And that $1 million for married filing joint, it would be $500,000 worth of debt if you were married filing separate. One of the other things to keep in mind, kind of skip down a little bit, is that equity interest is limited to $100,000. And once again, that is $100,000 in debt, not $100,000 in interest. So for those two items, the $1 million interest as well as the $100,000 of equity, if your debt exceeds the limits, then the calculation is performed in order to determine how much of that deduction you get. All right. The next item to note is that you can take your mortgage interest deduction on your first and your second home. And second home, that can be a lot of different things. So you would have in order to qualify as a second home, it essentially has to have sleeping quarters and it has to have a bathroom, okay? So what that means is that your boat, your RV, your timeshare, all of those items can qualify as a second home. So like I said, it's not uncommon for us to have taxpayers that have, a home that they may have owned before they got married, a home that they bought with their spouse, and possibly a timeshare. So with that being said, just know that you can deduct mortgage interest up to 2 homes, all right? Now, with regards to taxes, unlike mortgage interest, like I said, which can only be taken on your first 2 properties, property taxes can be taken on an unlimited number of properties. So that means, hey, guess what? If you had property taxes that you had on, in our example, 3 homes, your joint home, your previous home, a timeshare, a piece of land that you own in Montana, some swamp land that you got down in Florida, you can take the property taxes paid on all of those properties, okay? And then with regards to that, like I said, the 1098 will show the taxes if they were paid via the escrow. If you don't have the taxes on the 1098, then, you should either go to the county assessor's site. If they're not listed, you can always keep copies of your tax bills. You can always give those to your tax professional. The little devil in the details type of thing with this is that, let's say you had property, you had taxes with the first lender, and then your mortgage is resold and taxes with the second lender. You're going to want to make sure that you look on both 1098s to make sure that you have the complete amount of taxes. Another thing that happens sometimes is if loans are refinanced, once again, from one lender to the next, property taxes can sometimes be missed that way. A practice that we always use in our office is we actually go to the county assessor's website. So we're going to look and pull up the pen and see what the number is there. We'll confirm it with the taxpayer, and if they say, oh, yeah, I forgot that. And we actually had that happen one time. Person refinanced. We only had half of the mortgage interest and property taxes. We looked at it. It didn't seem a comparable amount to the year prior. So we asked them, and they said, oh, yeah, I did a refinance, and we got the second 1098 and made sure everything was included. So like I said, it's one of those things that the details actually matter a lot when it comes to making sure you get the benefit of everything. Also under taxes, just one thing to kind of note, it's not homeowner specific, but when you itemize, you can also take your state taxes that you have taken out of your check if you're working. If you had back taxes to the state that you had to pay, those items are allowed to be included. And if you made estimated taxes, for all of us, our taxpayers out there who are self-employed and make quarterly estimated payments to the federal and the state, once again, the state portion of that would be able to be deducted. The main thing to remember with regards to taxes is that it has to be either a state, local, municipal, county tax that is being paid in order for you to deduct it on your tax return. Uncle Sam doesn't give you any benefit for paying federal taxes. So once again, it's got to be for one of those items. And we'll kind of go through that in a moment. Points, like I said, the detail item on that is that they may have to be taken over the life of the loan. However, if the exceptions are met, you can then go ahead and take them in year one. And those exceptions generally have to do about whether it's common practice for points to be charged in your area, whether or not, there's a couple of, like I said, little extra items that go into that that will determine whether or not you can take the points all at once. All right. Credits. So like I said, as a homeowner, the big thing is energy credits and limits and lifetime caps come into play. So with that being said, for lifetime caps, if you have an item such as, furnace, heater, HVAC, windows, doors, people will often replace all the windows on the home that they have just recently purchased. The credit is limited over the course of its lifetime to $500 for all years after 2005. So meaning if you ever used the credit before, you may have used it all up. If you've never used it, it's going to be capped at $500. So, sometimes a taxpayer may be a little bit miffed when they say, hey, I paid $10,000 for all those windows and all I get is a tax credit of $500. Well, actually, in that case with windows, you would only get a credit of $200. And the credit may be $50, $150, or $300, depending on the type of property. But sometimes taxpayers, like I said, are a little bit shocked when they find out that the credit is actually a lot less than what they paid for the home improvement. Now, that's not to say that you don't improve your home, and it's also not to say that everything should be done for a tax benefit. We often tell people, hey, make the decisions that you want based off of, life, personal, finance decisions. And if you get a tax benefit from it, then, so be it. But don't simply do things just for the tax benefit because, like I said, sometimes the benefit isn't as great as what you would think. But needless to say, if you install any of those items, just know that there's a lifetime cap of $500. And then for the energy credit, that is a 30% credit for energy efficient, like I said, wind, solar, roof, electric heating type things. And the good thing is that you can carry forward any unused amounts. So, let's say that, the credit reduces you to zero taxable income, so to speak. You won't lose the credit. It'll just simply be suspended, and you'll get to use the rest of it in a subsequent year. Okay? The last thing really isn't, everyone is a new homeowner, so this should hopefully be far down the road for you all. But gain upon sale of home. The important thing to remember with this is that when you decide to sell your home, if it appreciates in value, then the gain can be taxed by Uncle Sam. However, if you are, single or married filing separate, $250,000 or $500,000 if you're married filing joint can be excluded for your primary residence. And primary is in quotations because, there are certain rules. You have to live there X amount of years before you do the sale, et cetera, et cetera. But just know that, just simply because your house, appreciates and, was worth $100,000 and now you sold it for, $200,000, don't get freaked out and assume that you're going to end up paying a gain on $100,000. That actually would be, a non-taxable transaction. Now, if you were in the lovely state of California, where, people had homes for $200,000 and now they're worth $1 million, and then they sell the home for $1 million, yeah, you got a gain of approximately $800,000, of which you can exclude a portion of it, but then know that a piece of it is going to be taxed. All right. And before I forget, I just want to kind of jump back up to taxes for a second. A lot of things that, we see it happen. Sometimes you can get a benefit on your state return for taxes. So state of Illinois, you actually receive a property tax credit for taxes that you've paid. So not only can it benefit you on the federal level, but you can also get something for the state level. So once again, there's multiple ways that you can receive benefit, and you just have to be aware of that so you can remind your tax professional if you don't see it on the return when you get done. Or, like I said, if you're doing it yourself, that you can make sure that it gets claimed. All right? So, other items. Once you begin to itemize, it allows you to take advantage of other things that maybe you are doing in your life. So, moving expenses. If you moved greater than 50 miles to take a job, then some of the costs of that move might be deductible. So let's say you move from Chicago to Rockford. That's greater than 50 miles. And you took a job in Rockford. That constitutes a move that qualifies for, being able to deduct moving expenses. Now, moving, that distance may not yield a lot of moving expenses, but if you move, say, from Chicago to, like, Colorado or California, we've had clients that have done that, and you are not reimbursed for those expenses through your employer. So, we know some people take a new job in a new state because, their company says, hey, I want you to be the, district manager here, and, we'll pay for the move. If you're reimbursed, you can't get a benefit for that. But if you pay out of pocket, for the move, then the travel, the lodging, the moving and storage of your goods, those items can be deducted, okay? So that comes into play now that you're itemizing. It's not necessarily on the Schedule A, but it's one of the things that kind of comes into play when you move, so to speak, or buy a new home. Medical expenses. Most medical expenses, to be of benefit to a taxpayer, have to exceed 7.5% or 10% of your income depending on age. The 10%, this is recent. These are recent changes. The 10% is for everybody who is below, essentially, senior or a stately age, and the 7.5% is for those individuals because their money is a little bit more limited. But when you begin to itemize, you can now deduct those medical expenses. So let's say you are a senior and you had a bad bout for a year and you had a lot of medical expenses. Well, guess what? If you itemize it and you had a home and, did some other things, you can deduct those. Now, this brings me back to a point that I made earlier, which was regard to home improvements, okay? If you make a home improvement as a result of a doctor's order for something health-related, you may be able to deduct those. And it's, of course, going to depend on the dollar amount of that. But, if you make an improvement, say your doctor says, hey, you're getting a little bit, up there in age, and for your own safety, I don't think it's good for you to be going up flights of stairs in your 5-story mansion. You should install an elevator. Now, let's say that elevator costs you $8,000. The way that the rule works is that you can deduct the cost of that medical improvement to the extent that it did not increase the value of your home. So let's say that subsequently, you install the elevator, you have an appraiser come out, and they said, oh, yeah, well, as a result of this elevator being installed, your home increased by $4,400, okay? So to the extent that it did not increase the value of your home, a.k.a. $8,000 elevator, $4,000 appreciation, means that $3,600 or $3,600 is the deduction. So if you are under the advice of your medical professional installing or making an improvement to your home, that you can deduct as a medical expense in the year paid. So that doesn't need to be capitalized and add to the value of your home. That can just simply be taken, okay? All righty, charitable contributions. Hey, are you a good-hearted person? Do you give money to all those different little people always asking for you? Gifts of cash and goods may be taken. Of course, you'd have to keep evidence of your deduction, and that's very simple. It's either a canceled check if you're doing something with, one of the entities via your job, and they do a payroll deduction. It'll usually show up on your W-2. Donation receipts, if you give to, any of those organizations, Goodwill, Salvation Army, AMVETS, if you have any of those receipts, that would be something that you would want to keep. Or if you had a letter from your organization, hey, if you gave, $500 to, the Knights of the Holy Grail, and they are a qualified 501c3, they should give you a letter at the end of the year saying thank you, for contributing. And that would be something that you would also want to take off. So like I said, these begin to come in play when you start itemizing. Miscellaneous expenses, these, are items which they're subject to a 2% floor of income. But things such as, job expenses or unreimbursed job expenses, this usually is in play for a lot of our tradesfolk, our carpenters, our, city workers who are out there, doing maintenance and have to come out of pocket for their own tools and, safety equipment, these things. If it's not reimbursed by the employer, but it is required as a condition of your work, then it can be deducted. So, certain police officers, maybe like the special detail, those that are on SWAT, those that are, on narcotics, they have to have certain equipment, and the department does not pay for it. So, they have to pay, $2,000 for certain weapons and things like that, and it's not reimbursed. To the extent that it exceeds 2% of your income, they're allowed to deduct those. But miscellaneous expenses, like I said, unreimbursed job expenses, tax preparation fees, so if you pay for software or if you pay a tax professional, those things are also allowed to be deducted. And another item that, once again, doesn't really show up on the itemized, it doesn't show up on the Schedule A per se, is the business use of home. So if you have a home and you either have a business or you work out of your home, you may be able to deduct certain costs to offset the income that you generate. So, if you have a home-based business, you generate $10,000 worth of sales, you can deduct, the cost of the, mortgage interest, property taxes, utilities, maintenance, repairs, depreciation. Those things come into play, and you can list them on Form 8829. It helps reduce your profit, and it helps, you save on your taxes. There's a simplified method, too. You don't necessarily have to keep track of all those things. It's basically take the amount of the square footage of your home office space, multiply it by X dollars, approximately 5, and you're allowed to simply just take that deduction, okay? But once again, these are all the other items that come into play when you have a home or you begin to itemize, all right? So just a couple of things to keep in mind as we are getting close to our Q&A session is, once again, itemizing lets you benefit from other expenses, such as A, gifts to charity. If you note item number 16, it says, gifts by cash or check if you made any gift of $250 or more. See instructions. I can tell you what the instructions say. They say if it's over $250 or more, you want to make sure that you have a receipt, or a letter from the organization to document that. All right. If you make donations of other than, cash or check, if it's over $500, you have to use Form 8283. And I'll let you in on a little secret. If you are very wealthy or you give away a lot of items, or let's just say you were getting rid of one home, gave away a bunch of stuff, and now you have a new home, so the stuff you gave away, you say, I gave away a furniture set and a bed and all this other stuff, and you say it was worth $7,000. The IRS is going to require you to get an appraisal for anything that is over $5,000, so just keep that in mind. Next item is casualty and theft losses. So if you have suffered damage to your home or damage to your personal property that is not reimbursed by insurance, or to the extent it is not reimbursed by insurance, you can deduct that as well. Next thing, job expenses. So once again, I kind of mentioned, unreimbursed job expenses are shown in line 21. 22, there's where your tax prep fees would be listed. And then 23, other expenses. If you have investment expenses, if you had a safe deposit box, there's a host of other things that you can also deduct. The item to note here is, like I said, it must exceed a floor. So you can see in line 26, it says multiply line 25 by 2%. It has to be greater than 2% of your income, okay? The last thing to know is, other miscellaneous deductions. That is for, like, gambling losses, and there's a whole host of other things to the extent that you have gambling winnings. You can also deduct those things. So you can see line 29, that would be all your itemized deductions. That would be mortgage interest, property taxes, charitable contributions, job expenses, tax prep fees, all these things, they can add up. Like I said, you can go ahead and you can deduct those. If you look at line 29, you can see it says, is that amount over $154,950? Meaning, is your income over $154,950? Then your itemized deductions may be phased out or limited, so to speak. We do have some high net worth individuals in our practice, and yes, their itemized deductions do get reduced. So it's just something to keep in mind, but something that your tax professional should have their eye on for you. All right. So that is it. That concludes, the actual presented portion of our presentation. And we'd like to give you a special gift. So as I indicated, we've got a lot of people on with regards to new homeowners in our area. And in a continued effort to welcome you to the neighborhood and help reduce some of the stress with taxes this season, we would like to extend the following gift to you should you become a client. So the first thing is a 30-minute tax impact analysis and Q&A session. If you just had any questions with regards to being a new homeowner and what's deductible and how could this benefit me and where do I look for this, we will extend that to you. Like I said, it's free, no charge, and it can be live in the office or it can be done via the phone, okay? The second thing is if you become a client, we will give you a $50 Amex Visa gift card, or you might be receiving a check at the end of the season. Depends on how we want to do that. But the thing to note is that if your tax fees are, for example, $275 itemized return, just know that as our gift to you, you will receive a $50 payment at the end of tax season, roughly around May, when we do all of our other referral payouts, which I will mention to you, at the end. So your fees wouldn't actually cost you $275. They would cost you less than that. So just know that. And this is probably the best offer for being an attendee, is we are offering you a BOGO, buy one, get one, 50% off next year's tax prep. That's right. Your tax prep fee for next year will be 50% of this year's bill. Or said a different way, we'll essentially take 50% off. So once again, like I said, it's roughly $275 in order to have your taxes done. However, as a client this year, you will receive half off of next year. So you're already locking in savings by simply becoming a client. Now, I'll leave this up for a second. In order to claim that free gift, you can either call the office. You can speak with myself. You can speak with Stephanie. You can speak with Patricia. any one of them will be able to, assist you and, make sure that that gets noted on your file. Or you can email me directly. My contact information is right there. All right. So like I said, I will leave this on the screen for a moment. But now is the Q&A session. And like I said, if you would like to ask a question, you will see at the top of your screen a little green chat bubble, and you can just simply type your question in there, and we will see it on our end. And we'll do our best to get to as many questions as we can. And, okay, so we've got, can a cabin qualify as a second home? And the answer to that, the question must be within reference to having a first and second home. And the answer to that is yes. A cabin can qualify as a second home so long as, once again, it has sleeping quarters and it has a restroom, So if you have, a home here and you have a cabin that you have, you can also deduct mortgage interest that you're paying on the cabin. So yes, that is it. And as I mentioned, it's not uncommon, even like a timeshare is allowed to count as a second home. The funny thing about that is that, so say you have, like I said, in our particular example, it was a person, they had a home prior to marriage, they had a home with their spouse during the marriage, and they also had a timeshare. Well, that's 3 homes. But you can pick and choose which of your extra homes you use as the second home, okay? So one year you may use one home because, it's got much more interest. The second year you may use a completely different home because, you now have another home. You sold the timeshare and you bought a mansion out in Malibu. So you can switch that around. It's really up to you. But yes, you can take mortgage interest on a second home. All right, and we have, what if I have more than one second home? All right, so yeah, that was that. What are job expenses? Good question. So this isn't related specifically to home ownership, but job expenses, like I said, are things that are a condition of your employment that are not reimbursed. So you need them as a condition of your employment. Your employer does not pay for them. Like I said, we usually find this in the trades, so for example, you're a construction worker. You're on a certain union job. They say, guess what, you got to bring all your own tools in order to work on this job site, and we're not paying for them. And that requires you to have, a miter saw, a recip saw. You may have to have, a table. There's lots of different things that you might have to have that they're not going to reimburse you for. Well, those are the items that you would list, and those would be included for you to potentially deduct. It's also not uncommon to say that, a company says that you can work from home, and you don't have an office that you can physically go to. So they say you work from home. Those unreimbursed expenses of you having, an internet line or having, a cell phone or other things, those also qualify as, unreimbursed business expenses. So there's lots of things that you can look at with regards to that. You can always send us a question. We have plenty of, literature that we could share with you and send to you for you to take a look at. All right, let's look at some of the other questions that we have floating around out there. So what if I have a multi-unit and I live in one and rent the others? So with this one, I'm guessing the question is, what if you have a building, a multi-unit building, in which you live in one unit and the others are rented out? This is actually rather common in the city of Chicago because, of the amount of apartment buildings that we have. With this, certain limitations are going to come into play. So we'll keep this a very simple example. If you have a 2-flat, you live in one and you rent out the other to a tenant, someone else, okay? The amount that you pay for mortgage interest, the amount that you pay for property taxes, etc., is going to have to be divided 50-50 between the piece that is rental, and then the piece that is personal. Now, the personal piece will, of course, show up on your Schedule A. The rental piece will show up on your Schedule E. Now, the little nuance, because we do specialize in real estate transactions and taxation, you, on the rental side, will not be able to have a loss on your Schedule E. So if you have $10,000 worth of rent and the 50% component of property taxes and mortgage interest, etc., would make you have a loss of $5,000, the IRS is going to limit that loss because you live in the property. So therefore, you would never be able to have a rental loss so long as you live there. But once again, you would be able to benefit from taking your 50% share of the property taxes and mortgage interest, on your Schedule A. So once again, that's a very good question. But that's one of the nuances that we often see, here in the office on various tax returns. What other questions do we get? Who gets the taxes shown on the HUD? Okay, this is actually a very good question. With regards to taxes taken on the settlement statement, HUD 1 or RESPA, there actually is a law with regards to who gets to take them, whether it's the seller or whether it's the buyer or whether it's a proration, and that can actually come into play too based off of when those property taxes are paid, because here in most of the northern Illinois counties, I'm not familiar with the southern Illinois counties, we pay our taxes in arrears. So everyone now is getting tax bills based on off of the previous year. So a calc may have to be done to determine, okay, can I take that now or can I take that later? It kind of depends. But, I mean, that's one thing that I bring it up with a tax professional, make sure you have your HUD 1, and then they would be able to determine, whether or not you could deduct it or whether or not somebody else could deduct it. So we have a question, are simple home improvements such as the purchases in the example of doors, paint, window treatments, etc., deductible? They are to the extent, like I said, that they are energy efficient or that they are envelope components. And what I mean by that is exterior. So exterior doors, exterior windows, heating elements, insulation, things that improve the energy efficiency of your dwelling. But general things such as the painting would not. Window treatments, I guess it really depends on what's being done to the window. If you installed a new energy efficient window, yes. But if it's, maybe just like an enhancement, I would say maybe not. But those are all things that could be analyzed to determine whether or not they are deductible. And once again, good question. Are refinancing costs deductible? Refinancing costs, once again, is kind of going to depend on what costs are involved. But generally speaking, a lot of things that we see for a refinance aren't deductible, because like I said, it's usually like attorney's fees and closing costs and things of that nature. Those aren't. But once again, I would say have the HUD 1, have the settlement statement, provide it to your professional, or like I said, if you're doing it on your own, seek competent guidance on it, and they'd be able to tell you whether or not, it could be written off or not. Are energy credits worth it? Somebody was listening to the section on saying, hey, I paid $10,000 for windows. Can I get those energy credits? I'll give this piece of information, which is a credit is a dollar for dollar reduction in tax, okay? So if you have a $300 credit, that's going to be far more valuable to you than a $300 deduction. So a $300 deduction, for example, could be, your standard deduction, so to speak, or, hey, I made a $300 charitable donation. That's a good example. So I made a $300 charitable donation. The thing to remember is that it's going to run through your tax bracket to be determined the impact of that. So let's just keep it real simple. Let's say you didn't make a, buku bucks in the year, and you made a $300 donation, and your highest tax bracket is 15. We work in a marginal tax system, meaning it escalates from, 15 to 20, up. The more you make, the last dollar is taxed at a higher rate, up to 39.6% if you make over $400,000. So with that being said, if you were in the 15% tax bracket and you made a $300 charitable contribution, the reduction in your tax bill is going to be 15% of $300 or $45, okay? Whereas if you had a $300 credit, you would get $300 off your tax bill. So as you can see, $300 credit is far more valuable than a $300 deduction because it only yielded a $45 tax benefit. So to the extent, I understand the question, should I go and make all these home improvements and do all these different things, even on the energy side, if my credit isn't going to be that great? Once again, like I said, do things that make financial sense for you. If you want to enhance your home, enhance your home. If you want to potentially get a credit for something, just make sure it's researched and that, you do it so that you do receive the benefit of it. But like I said, don't do something solely for the benefit of it because, like I said, you might, be disappointed. But I always tell people, a credit, anything that reduces your tax bill, I definitely would go after it, So I personally think that they're worth it, but, like I said, you have to keep it in perspective. What happens if you have a loss on the sale of your home? Can you deduct it? The short answer to that, because we are running up on time, is no. You can't deduct it. And there actually could be other ramifications if you had a loss on the sale of your home, depending on if you were in foreclosure or if you, short sold your home. There's things that kind of come into play. And we are talking about your primary residence. We're not talking about rental properties or investment properties. That's a completely different story. But if you have a loss on your home, your primary residence, no, you can't deduct it. Now, yeah, it's like the double-edged sword with Uncle Sam. If you have a gain, we'll tax it. If you have a loss, you can't take it. Well, wait a minute. Yeah, but all right, fine. We'll exclude $250,000 of the gain. But, yeah, you can't deduct the loss. All right. And we've got any tips for charitable deductions? As I kind of mentioned, with regards to gifts to charity, I would say, first and foremost, just make sure that you're giving to a qualified charitable organization. I don't have it in front of me, but we have a ton of articles on our website, in our blog, for you name the topic, you can find it. So the website is up on the screen right now, wilsonrogers.net, not .com. That is a different company up in, I believe, Washington or California, Canada. But wilsonrogers.net, N-E-T. And if you just go to our blog tab, we've got plenty of different articles. I know specifically there's an article that's written about charitable contributions, and with regards to that, you just want to do a search. The IRS has a lovely tool that will make sure that you can look up a charitable organization and see if they actually do have tax-exempt status with the IRS. But I would say you want to make sure that you're giving to a qualified organization and that you're keeping a record of that donation. So like if you're giving cash, once again, cancel check, bank statement, something that indicates that you gave the money. If you're giving to like your church, we know sometimes people will give love offerings or they'll put the money in the plate and they want to be anonymous. Well, that money, it can't be tracked usually. So, the pastor or the people, they can't tell you, oh, yeah, Jared, you gave us $1,000 this year. So, while you may want to remain anonymous and you may want to have that gift be between just you and that you worship, just know that you want to keep a record of it. So if it's easier to just write a check to the church and they give you a statement at the end of the year that says, hey, Jared, you gave $1,000, that's what you want. But any cash donations, you want to keep a record of it. Cancel check, something that indicates that you gave it to a qualified organization. And if it's a good, so meaning, like I said, You just go and you drop stuff off at Salvation Army, Goodwill, or any of those things. They'll give you a donation receipt. They will not tell you what the value of your goods are. There's plenty of guides out there that you can use to estimate the thrift shop value of your donated goods. And we have guides here, so we can provide those to you if you were asking for them. That will help you estimate the value of what you're giving away. But always get a receipt, indicating the date. I often, write down on there, hey, it was a box of clothes and some gym shoes and some household items, and I usually just scroll down a number of what I believe the value approximately is, $70 worth of household items, and then I just throw it in my little folder, and then come tax time when I'm doing my taxes, which, because if we do taxes, usually is not as early as I would like it to be because I'm working on everybody else's taxes, we then go ahead and make sure that all gets tallied up and put on our Schedule A so that we get benefit for it too. But that's it. And this will be the last question because I'm just looking at it. We're running just a little bit over. It says, who benefits from medical expenses? I'm going to take the interpretation meaning like what type of person benefits from medical, and it's traditionally going to be our more stately individuals in life, our patriarch figures, our seniors, They don't have a lot of income. They may be getting Social Security, may be on a fixed income, may have a pension. They're going to be the ones because, they got maybe $30,000 worth of income. And, of course, as we all get to that level of our life, the medical bills are going to start, and they're going to start to add up. So, if I make $30,000 and I had, unfortunately, $10,000 worth of medical expenses, 30,000 times 0.75. Sorry if I was doing my math right. It's been a long day here in the office. 30,000 times 0.075 or 7.5% means that to the extent that the medical expenses exceed $2,250 for that person, they're going to be able to deduct them. So like I said, this individual had $10,000 worth of medical expenses. They're going to be able to have $7,750 count on their tax return on their Schedule A. Now, if the individual has been living in their home for 30 years and doesn't have a mortgage and doesn't have a lot of charitable, they may not receive the benefit of those expenses, but that's who benefits from it, is our senior individuals who are starting to incur more medical expenses and don't have a lot of income. Us, the younger, more sprightly, individuals who can go out there and jump off a bridge and, break their back and, et cetera, they're going to be the ones where the medical expenses will not count. We will, of course, would include them on their tax return. They just wouldn't receive a tax benefit for that. Okay. All right. Well, it is at the end of our hour. I thank you for joining on the call, and I thank you for participating. Our information is listed, on the slide. Like I said, office information, telephone number. We are on Twitter, Facebook, and then that last little piece of it is the website. Like I said, you can look at our blog and you can see a ton of different things. But with that being said, like I said, if you have any questions, if you'd like to take advantage of this offer, redeem it, go ahead, shoot me an email, or like I said, call the office. We'd be happy to take care of you. And at the conclusion of this presentation, we will have a recording and a replay of it. So in case there was anything that you missed, you can go ahead and request a copy of the replay, and we would be happy to send it to you. All right. Well, once again, I thank you for joining us, and that concludes our presentation. You go ahead, and everyone have a very wonderful evening. I will talk to you all soon. Thanks a lot. Bye.